Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, let's be an anti-delta person. Let's take the other side of the trade, and let's say that we think the underlying isn't going to move that much. We think it's going to stay the same. We believe that the currency or the stock or whatever we're trading is going to stay around the same area. One thing we can do is we can sell a short call or a short put. Now, the benefit of doing this is that the margin requirement is only there for one side of the trade. If you sell a naked put, you're going to have the margin requirement for the naked put. But if you combine it with a naked call, assuming you qualify with this through your broker, there's typically not any additional margin requirement just because of the fact that it's mathematically impossible for you to lose on both sides of it. Now, with that being said, I was talking with my partner, and he's traded on the floor before, and between the two of us, we have over 20 years in the business, and we were talking about straddles the other day and selling short straddles. In his career, he's seen two people actually peg a straddle, meaning that it actually closes right at the money, meaning if you XYZ's at 50, you sold the 50 call and the 50 put, that he saw the stock actually close at 50 to where he got the full profit from the straddle. In my career, I've actually never seen it. I've heard of it, but I've actually never seen it with anything that I've traded or any of my clients' money or anything like that. So my point is that don't plan on getting the full premium when doing a straddle. When people look at that, they say, wow, look at all that premium that I can get for just going at the money with both the call and the put. And I just want to emphasize it's probably not going to happen. You usually need to get some type of an early exit strategy with it. Now, a lot of times if we're ever doing a naked short straddle, we're looking to be in and out fairly quickly. Our general rule, and it's not applicable to every situation, and I probably shouldn't even say it's a rule, it's just more of a guideline. We're looking to get about 10 to 20% of the premium with which we take in. So for example, let's say XYZ is at 50 and we got $1 for the call and $1 for the put, then we're looking to get about maybe 20 to 30 cents. Once we can get that much of a profit, we're looking to get out. So with that, and to say that the naked short straddle is a big part of our business would not be true. It's a very small part of our business. Now, once again, let's go through the disadvantage. You double your chance of losing. So if you just sold a naked call, you only can lose on one side if it goes up. Now, you have twice as much chance of losing. So with that being said, you can lose on the call or the put. The other disadvantage, obviously the unlimited risk. I'm not going to get on my soapbox again about that, but I'm sure you guys get the idea on it. The other disadvantage, the underlying needs to stay within a range. This is the type of strategy with which your enemy is movement. Just like in the long straddle, your enemy is non-movement. In the short straddle, your enemy is movement. Know your enemy when doing a trade. Now, Vega, and this kind of addresses the implied volatility question that we have from the audience. If you believe that implied volatility is going higher, then a straddle is something with which to consider. It's a market neutral trade, meaning that if the stock can go up or down, and it's probably not going to affect the straddle too much in terms of having risk, in terms of movement of the underlying. You'll make money on the call as you lose money on the put if it goes up, and the opposite is true if it goes down. What I want to get through here is what does implied volatility have to do with this? Now, if you believe implied volatility is going lower, sell a straddle. With that being said, if you're selling a naked short straddle, you need to respect the other factors of option pricing when doing this, such as the risk management of the underlying and that type of thing. So let's say that we believe that implied volatility in general is going to go higher. There's 6 factors of option pricing. I'm not going to go through all of them today, but implied volatility is definitely one of them. If the implied volatility of an option goes higher, then that means if all other option factors remain constant, meaning the underlying doesn't move, time stands still, no dividends, no interest rate changes or any of that, then the value of the option will go higher, whether it's a call or a put. So with that being said, we're neutral on price, but we're bullish on volatility. Buying a straddle is something with which to consider. Now, let's say that we are bearish on implied volatility, meaning we think implied volatility is going to go down, and that a lot of people are going to start selling these options after we do. And all other factors stay the same, the market stays the same, everything else stays the same like I explained before, and implied volatility on those options goes lower, then theoretically the value of those options will go lower as well. If you're selling a naked option, you need to respect the other factors. There's no law that says just because you sold your straddle, the market's going to be kind enough to not move for you. Trust me, it doesn't work. I've called Steve at the exchange and asked him to keep the prices still for me a day. He always says no to me. The other thing that needs to be respected is that if you believe that implied volatility is going higher, then you're not able to call God and ask him to hold time still for you to take away the time decay risk on buying that straddle. So you need to be able to respect the other factors of the marketplace, and just as the bottom bullet point says, never fly blind. Theta. Theta is the Greek that measures time decay. The sun rising tomorrow is the only guarantee that we have in all of trading, besides death and taxes, of course. So with that being said, oftentimes people like to take advantage of that in their trading and hedge themselves in one way or another. Short straddle or a short strangle is arguably the most efficient way to take advantage of time decay. Now, with that being said, of course, that's if you just flew blind and ignored all other risks that are involved with it. But my point is that this is where you can take advantage of time decay. And if you buy a straddle, that's where time decay is arguably going to hurt you the most. No guarantees that that's the way it's going to happen every time, but the reason that I'm going through this is that at-the-money options have the most extrinsic, aka time value in them. So because of that, you have the biggest benefit of time decay when you're selling a straddle and the biggest risk of time decay when you are buying the straddle. So that's kind of where we would go with that. Now I want to tell you why I really like currency options, especially right now in this marketplace. As I mentioned earlier, I'm a long-term bull. We've been through quite a bit of turmoil in the United States since the Great Depression, including the Great Depression, and the U.S. stock market has come back. We've had quite the resilient economy, quite the resilient market throughout a lot of bad things in our history. We've had the Great Depression, World Wars, Korea, Vietnam, the sideways market from 66 to 82, bear markets of 74, the S&L crisis of the 80s, Black Monday in 87, the real estate boom, the real estate bust in 08, the credit bust in 08, all the busts in 08. We've been through a lot, and we're still here. So with this, I'm personally a long-term bull. And whenever I try and trade short-term in the stock market, no matter what I do, that's a bias with which I've already have. Now, the other thing is that with currencies, I don't have a preconceived notion of the long-term dollar or the long-term euro or anything like that as strongly as I do for the long-term market of the U.S. stock market. So I'm able to look at currencies in a way with which I can view this with the ability to have kind of a clearer head, so to speak. Now, the other thing, this is part of a gigantic overall market. It's arguable that the U.S. that the currency market is the currency market is the most traded market in the world. And with that being said, you're part of a very big thing, so that's another benefit. And the other thing that I like about the currency options is that anything you do with stock options, you can also do them with currency options. If you're looking to hedge your portfolio and you're concerned with these British bonds that you have, you can buy a currency option on the pound and you can protect the value of the pound, so to speak, if you're concerned with the sinking pound or something along those lines. You have the ability to do that, and you can even do it in an IRA.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.